The year is 1918. After 4 grueling years of conflict, the First World War is over. America emerges victorious, flush with wealth, and immediately enters an era of high economic prosperity. Millions of troops return home to delayed projects springing back to life. At the same time, more women enter the workforce than ever before. Suddenly, a lot more households have steady, growing salaries to spend. Companies are eager for a piece of that new wealth. People start buying up newly invented conveniences, to the early radio, making household technology a hot commodity. To keep the sales momentum going, banks start handing out consumer loans to everyday people. Now anyone with a salary can finance the ultimate symbol of the decade, Henry Ford's Model T. Taking on debt used to be a last resort. Now, borrowing money is entirely acceptable, shifting from a simple way to buy appliances into a socially approved strategy for building personal wealth. With extra cash in hand, average citizens decide to put their money to work. Cooks, shoe shiners, and taxi drivers start pouring their savings into Wall Street, treating the stock market like a guaranteed payday. This diagram shows how margin trading accelerated the boom. People borrowed heavily, combining a little of their own cash with massive bank loans, funneling it into stocks. Behind the scenes, banks quietly took money from customers' savings accounts to buy stocks for their own portfolios. By 1929, the results seem spectacular. America's total wealth has doubled in less than a decade, and investments are up 218%. Everyone feels rich, but the entire system is propped up by borrowed money. The market is completely detached from the actual value of the companies it represents. On this chart, the divergence is clear. The stock market line reaches record heights, while physical factory output begins a steady decline. As production drops, wages fall, and consumers stop buying. Worse, climbing interest rates make borrowed investment money much more expensive to maintain. Despite these glaring warning signs under the hood, the public ignores them. Driven by greed and past momentum, people keep buying in, assuming the good times are permanent. When a financial system separates entirely from the physical reality of the businesses it tracks, the math catches up. A catastrophic correction becomes inevitable. The fever breaks on October 24, 1929, Black Thursday. A wave of uncertainty finally spooks investors, and at the opening bell, they trigger a mass sell-off. The trading infrastructure collapses under the pressure. A record 12.9 million shares are dumped on the market, moving so quickly that the physical ticker tape machines fall hopelessly behind. As prices free fall 11%, the delayed machines leave investors entirely blind. They're dumping their life savings without knowing what their shares are actually worth in the moment. By Black Tuesday, it evolves into an outright panic. The Dow plunges another 12%, erasing $40 million in a single day. Shares that made people rich the week prior are now completely worthless. Because banks had gambled with everyday customer deposits, the market's ruin instantly drained the savings accounts of families who had never even owned a share. Citizens rush to their local branches to withdraw whatever money they have left, only to find empty vaults. For every dollar they deposited, they are lucky to get 10 cents back. The fallout ruins wealthy speculators and everyday workers alike. It destroys the structural foundation of the American banking system, turning a market crash into a decade-long economic depression. For the next 3 years, the Dow Jones bleeds out, losing 90% of its peak value. Meanwhile, unemployment climbs to a staggering 24.9%. Thousands of companies close their doors. Bread lines, soup kitchens, and mass homelessness become the permanent reality of the American landscape. Thanks to a rapidly globalizing financial network, the collapse easily crosses the Atlantic. European nations, still recovering from the physical destruction of the First World War, plunge into their own severe economic despair. This widespread poverty is quickly weaponized. In Germany, the deep economic desperation creates the perfect conditions for the rise of the Nazi Party and Adolf Hitler, steering the globe directly toward a Second World War. Throughout the 1930s, the government launched massive fiscal interventions to try and stabilize the economy, but even billion-dollar social programs struggle to move the needle. It was only the sudden, overwhelming demand for artillery and military aircraft in 1939 that finally ended the decade of stagnation. But the devastation forces a permanent reset of the financial rules. In office, President Franklin D. Roosevelt introduces sweeping legislation designed to safeguard the system. He establishes the Federal Deposit Insurance Corporation to permanently protect everyday bank accounts, and the Securities and Exchange Commission to enforce strict, fair trading practices on Wall Street. These institutions still protect our wealth today. But while laws can mandate transparency and ensure deposits, they cannot regulate human nature. The greed that builds a bubble and the fear that bursts it are flaws we still have to guard against.